Hello to all fellow market enthusiasts, technicians, traders, and chartists. And thank you to XTB for having me as a speaker for your masterclass series this November 2025. Today, I'm going to talk about what is our human edge in a world where we have algorithmic trading and so many automated systems running in the background. So with that, I'm going to get started showing my presentation and let's get going. Okay, the human edge, trading wisdom in the age of algorithms. I'm going to look at what algorithms can do better, but also what we can do better as humans. Okay, so in a world where AI and algorithms dominate the markets, what is the role for us as technicians and discretionary traders? So one area, behavioral finance, shows why traders often sabotage their own success through biases, cognitive biases like overconfidence and loss aversion. And then how to turn these human quirks into strengths. What are the enduring principles that separate successful traders from the rest? How do we harness and protect one's advantage that no machine can replicate? So first, let's start off by looking at the market participants and volumes and how those have evolved. But more important, a note on technical analysis and its start. The original candlestick. Okay, you have to start off a presentation with a little bit of humor. And I took this photo when I was in Tasmania, and it just struck me how perfectly framed it was. In addition to the vertical on our charts, we also have the horizontal, the waves. And throughout all of this, this is what we're dealing with. Linear thinking in a cyclical world. So sometimes with straight line thinking, that means projecting too far in advance or too straightforward. We fail to recognize many of the variables that we cannot solve for, especially in markets, because they're not a closed system like a deck of cards. They're an open system, which is like the weather, where new things are introduced every day, every minute. And it's hard to take this into account in our analysis. So we'll look at how we deal with that in the second half of this presentation. But first, the paradox of modern trading. Algorithms currently handle over 80% of market volume. Yet 90% of the traders still lose money. Why? Because technology's revolutionized tools for all of us. And retail traders have more access to technology than ever before at no cost very often. So most traders lose money not because of bad tools, but bad decisions driven by emotions or cognitive biases. How many of you remember a stock in the United States called GameStop? GME is the symbol. And in 2021, there was a crazy frenzy that was also driven by a Reddit group, and the herd behavior fueled totally irrational buying. So the Reddit group, often referred to as diamond hands, hold it and squeeze the other side. So this is what that stock did in 2021. It's sort of like the tulip frenzy decades and centuries ago, where we had the black tulip bulb driving crazy decisions. And this here was somebody paying $120 per share for a black tulip bulb. Now, what's interesting is it spiked way up and it fell right back down again. But if that wasn't enough, now I've got a monthly chart on the other side, and you can see multiple spikes: one, two, three, four, five, six, at least. So you would think that people would learn that it's a spike up and then just comes right back down. But that was not the case with this GameStop, and it was a cult behavior. So the growth of algorithmic trading, so that's just an aside. Keep that in mind and recall if you've ever had some crazy emotional trade, okay? Historical growth of algorithmic trading. In 2003, algo trading was 15% of the US volume. I don't know about the rest of the world, but I do have the data for US volumes. By 2010, it exceeded 70%, and it's currently estimated to be between 70 to 75% for all US equities today. So, advances in AI, artificial intelligence, cloud computing, and high frequency trading, which is a subset of algorithmic trading, fueled adoption. This HFT, or high frequency trading alone, where trades are made in milliseconds, can contribute up to 50% of the volume in equities. The percentages are actually higher for liquid markets, such as Forex, where this automated trading can account for up to 85%, and lower in bonds. So keep in mind that automated trading also includes arbitrage, perhaps arbitrage between different banks, the cash market, etc., but it is 100% automated. And so, even though retail volume has been rising, most of the institutions drive the volume, and it's always been that way. So, automated trading and artificial intelligence. We have several different types of artificial intelligence, actually, about 10 different types, but I'm not going to go into them here. But we've got the algorithmic execution. Perhaps some of you have heard of the VWAP, which is similar to a moving average, or time slicing, where if a large firm has an order to execute 1,000 futures contracts or 100,000 shares of a stock, they'll very often go in and do X amount every minute or random intervals. So that's considered time slicing because it increases the efficiency of execution. And this is going on all the time in the background. So, first of all, I want you to understand that this automated market making, if you will, is a very good thing for us. The reason why it's a good thing is because it is a provider of liquidity. We need bids to sell, we need offers to buy, and we no longer have the traditional exchange floor pits like we did when I started trading 45 years ago. We also have short-term technical strategic strategies, such as those used by hedge funds and multi-million dollar, billion dollar offshore proprietary trading firms. And of course, artificial intelligence, which includes things like neural networks, very sophisticated pattern recognition, etc. So, can technology and trading tools help prevent our human errors? Okay, we've revolutionized all these tools, but the challenges like market volatility still lead to human error. We've got technology and trade management tools that are very useful, such as trailing stops. But the great majority of people don't use these types of tools. Most of our human errors come from cognitive biases, an area that behavioral finance explores. Let's just look at a few, okay? And these are what hold discretionary traders back. The obvious issues that hold people back, in addition to these cognitive biases, are risk control, overanalyzing markets, getting tripped up in the noise, and trying to do too much while still on the learning curve. So, this comes down to experience. And for many of us, it takes a minimum of 3 years, sometimes up to 10 years, to fully find our way in our style that suits us and be able to do it consistently. Big key there, consistency. So these biases have always shaped markets. They lead to the crowd behavior, the fear, and the greed. Why do traders hold positions too long? Losing positions, that is, because people fear losses more than they value gains. Have you ever held a losing trade hoping it would recover? That is your brain talking, not the market. Traders are so often caught in what we call FOMO, or in English, the fear of missing out. So our emotions cloud our judgment. We regret holding losers or basking in the pride of open profits. But we can't trade well if impulsive decisions are fueled by fear and greed. And I'm human too. I experience times where I am fearful or greedy, but I'll share with you the tools that I use to curb that and help provide a statistical framework for myself. So, looking at a few of these cognitive biases, because they are such an important part of trading that really is not discussed enough. And I'm sure most of you have been exposed to the list of these things and you're aware of them. But overconfidence is a big one. And it leads us all to overestimate our predictions. We're overconfident in our abilities. We're just human optimists that we can do better than everybody else. So Paul Tudor Jones's quote, and of many that I really like, don't be a hero and do not have an ego. Very important, because egos box us into a corner and take away our flexibility. George Soros, and I'm sure most of you have heard of him, he used the theory of reflexivity, which he popularized in application to the financial markets. So that is that very often our market perceptions shape the reality, okay? So he looked for this moving from one extreme to the other extreme, and that was his way of countering his confirmation bias, which simply means seeking data to support our beliefs or our existing positions. So he really looked for things to move beyond what might be perceived value and in part driven by the crowd behavior. And then Warren Buffett, who has now stepped down, but he avoided the anchoring bias by ignoring the market noise. An anchoring bias is when we fixate on an initial piece of information, like a target price, and then it skews our future decisions. So Buffett used to anchor on the intrinsic value that he saw for the long term and not the volatile price swings. So most of us don't have that 10-year time horizon that Buffett was engaged in. Most of us tend to be more technical and definitely shorter term on our trading. And a lot of that is a function of our account size. So the smaller the account size that we have, the shorter the time frame that we should be trading on. We can't escape our human emotions and cognitive biases. And I just love this little video of Spock, because I don't know how many of you remember the Star Trek series, but Spock was devoid of emotions. And unfortunately, we are not. We are also distracted by this digital technology, social media, and it has conditioned our brains to be overactive in clicking on the mouse, which generates a dopamine squirt and a whole host of other problems. Ultimately, psychology is going to be a big differentiator. That is the way that we handle our fear, greed, and uncertainty. So, yes, emotions can drive impulsive decisions, and the greed causes us to drop our guard and enter marginal trades, especially after we have just had a big winning trade or a nice winning run. Very often, traders find themselves assuming even more risk at the end of a big winning swing or taking marginal trades that they wouldn't normally be taking if they hadn't just been coming off of these big wins. So think back to your own trading and your own portfolio and see if this holds true for you. Self-awareness is always going to beat prediction. So just be aware of when you are more emotionally vulnerable. I can tell you right off the bat, I'm a lot more vulnerable if I have not had a good night's sleep, if I've had stress somewhere in my life, many things, death of a spouse, the IRS over here, moving is a huge stressor. So, all of these things are things that we need to be aware of where we're going to be more emotionally vulnerable. So, think back to a trade that you made that was perhaps swayed by the emotional or cognitive biases, because everybody has. So, cognitive biases 101. I love this little cartoon because literally the first thing that we see that agrees with what we believe is what we want to anchor on. Okay. We know we should be doing our own research, but we'll find that one little bit of information, that one particular analyst, something that's going to support our position. And yes, that's exactly what I was thinking. But that's selective data choosing, okay? So, this confirmation bias of looking for evidence that supports your existing beliefs is a problem. I used to have a gal that worked for me who was hysterically funny. Her name was Victoria, and she came up with what she believed should be called the time frame justification system. And that is when you are in a trade and things are just a little bit wobbly, and then we start going through different time frames to find the one time frame that might support our position. So I know I've done that before, and I'm sure many people have, but it's looking for the evidence that supports our position. And instead, many of the very, very great traders, including Paul Tudor Jones, would instead look at all the things that could go wrong or the evidence that might lead to the other side of the coin from what your position is. And then you're more apt to keep better risk control and trade management. Have you ever had that ostrich effect? Well, maybe if I just stick my head in the sand when things aren't working and ignore the negative information or risk, I won't have to look at it. A great way to get into trouble. But it's very easy to stop looking at something when it's not right and just hope that it reverses. And not a good thing. So, this is the ostrich effect. A few more cognitive bias traps just to be aware of. The illusion that more information is better. How many of you have often thought that? I had a very good friend and colleague who has since passed, and his name was Richard Arms. And once we were having dinner together, and he said, a person who has two watches doesn't know exactly what time it is. But a person with one watch knows exactly what time it is. So sometimes the more indicators we add, the more information we put into our equation, it's going to make the picture look cloudier and cloudier because we can start seeing more things that don't necessarily, they might conflict with each other or look noisy. So if I just had two things I was looking at, for example, let's say I'm just simply looking at the previous day's high and where the price is now, I know for sure if the price is getting closer or further away, as well as how quickly it is. So having more knowledge about volume and perhaps extraneous variables may not help me with my analysis. The overconfidence bias, we've looked at that. Overtrading, underestimating risk, and dropping our guard. The optimism bias, because we overestimate the probability of a good outcome. Loss aversion bias. We don't want to take losses because they're felt twice as much as gains. So therefore, we keep hoping that that market is going to turn around. And recency bias, that means being very influenced by the last piece of information. They have done studies showing that if they interviewed 100 people and showed them a chart where the last bar was a big up bar, and they said, now, what do you think the next bar will be? The great majority of them said, another up bar. So we're influenced by the most recent piece of information, and that may not be the case. It might be dependent on context. If we've been in a strong downtrend and we have a big up bar, perhaps it's just a short squeeze. So just be aware of the fact that we're always biased by that most recent analysis or bar that we've seen or heard. And there's more. It doesn't stop. The illusion that more knowledge is better, yes, and the optimism bias, but there's the ego bias. And I know that most people have felt this. Oh, here's all these biases. I know them all, but they don't apply to me. All right? So just be careful of that. They apply to all of us. Now, where is our biggest edge? Risk management. Number one, our biggest edge. It's not in our analysis as to what's going to happen next, what's going to happen the next day, the next bar. It's where is our risk management in case that doesn't happen. Because traders hate losing 3 times more than they enjoy the gain. So if we can immediately define where we're wrong or what is the largest loss that we're willing to take, then if the price goes to that area, we'll already have our stops or our management functions in place. Because I don't know about you, but if I don't have a resting stop in place or a level that's well defined and the market starts to go against me, I'll get out, but I'll probably get out a little bit after my stop would have been hit, or I'm a little bit late or a little bit slow. So have these levels predefined, and if you can, resting in the market. Jesse Livermore, who we know actually went bankrupt several times, said, playing the game teaches you the game as well. So very often, experience is our best teacher. So as long as you're on the learning curve, make sure that you're not paying too much to get that experience. Stay small, stay controlled until you feel very confident that you have a consistent process in place. And we will revisit this at the end of this presentation. Many traders would show a profitable year if they eliminated their biggest losing trade. So think back when you were trading. If you just eliminated your one largest losing trade, I bet you your bottom line would have looked a whole lot better because most traders end up having one huge loser because they're tired or they need a break, but they're not taking a break. And it's your subconscious way of saying, stop trading until you get a break. So if you took out that one biggest loss, it might make a huge difference. Even portfolio managers have thresholds that signals liquidation or adjustments to their leverage. More timeless wisdom that never changes. So, studying the masters and the great traders of the past, even if they were from 100 years ago, provides much wisdom that we can incorporate into our trading today, even though it's dominated by all these algorithms. Risk management is always the first and last edge. That was Paul Tudor Jones. So, the most important rule of trading is to play great defense, not great offense. Warren Buffett, the power of discipline and consistency. So, risk comes from knowing what you are doing, or rather, risk comes from not knowing what you are doing. I got to correct that one right there. By the way, my number one rule for myself in trading is correct mistakes immediately. I have this written down on my trade sheet because I often make execution errors, and my number one rule is fix that error immediately so that I can see without see in a more uh, clear way without the biases. And lastly, George Soros on adaptability and patience. These market laws of reflexivity, I already mentioned that, how we overshoot from one extreme to the other. So don't ever say to yourself, the market is too low or the market is too high to go. In fact, I think one of the most insightful stories came from the first Market Wizards book, and it was the chapter on Richard Dennis. If you don't know, Richard Dennis was half the brains behind the Turtles experiment. His colleague was a person by the name of Bill Eckert. So, Richard Dennis wrote that when he was a big trader, he used to trade sugar. And sugar had had a very pronounced parabolic spike to the upside. And when it started just to turn and come down, he shorted it and he made a lot of money. I would suggest you read this chapter in the Market Wizards book if you have that book available to you. But then when the sugar got down to that 8 to 10 area after dropping from 80, and now it's trading 8 to 10, he thought it had gone down low enough and he put on a very sizable position. Well, guess what happened? The price of sugar kept going down to 6. And because he had such a sizable position on, he lost more money on that last bit of trend than he made from shorting it right as it was coming off of its high. So you see, everybody has made the same mistakes over and over. Just be mindful of that. Okay, let's look at a little bit more detail on the human judgment in trading, okay? Because discretionary trading depends a little bit on our expertise. I hate that word intuition, but intuition, if you think of it as experience, and adapting strategies to shifting market conditions, which we're going to look at in some slides at the end here, okay? So it's very dependent on our ability to switch from uptrends, which is one state, to entering a trading range, which is another state. And sometimes the automated trading or the artificial intelligence is not quite as fast to adapt to changing conditions. Humans do have an edge there, but again, it's going to be dependent on your experience level. So different styles offer different risks and influence different trading outcomes. And we'll see where the humans actually can have an edge in more detail. But first, let's look at what the machines do better, because now they're so prominent. artificial intelligence can analyze the data faster than all of us. It excels at pattern recognition and it excels at high frequency trading. It is also very scalable. And we know that the computers do not make the same type of unforced errors that us humans do. Now, what can the humans do better? Since AI is trained on past data only, humans are better at dealing with black swan events or one-offs. How many of you have heard that in looking at probability distributions, the markets are not a standard bell-shaped curve, as statistics refers to it? Instead, the tails are much fatter than normal statistics. And what that means is that the probabilities of an extreme event in the markets are much higher than normal statistics would dictate. Okay. And so sometimes the humans have a better ability to recognize these aberrations, as we can also call them, than the artificial intelligence that has just been trained on past data. Okay, we may be better at spotting changes in these relationships. And again, that depends on our experience level. Now, machines excel in closed systems. And if you think of bridge and chess, the computers now can beat the top chess master in the world. But as you know, the markets are not a closed game. That means more chaotic events and lots of noise, which also trips both machines and humans up. And the noise level these days has increased exponentially from what it was 30 to 40 years ago. So with regards to that, more data does not equal better results. It might only introduce more noise, okay? And we know that the markets never unfold exactly as they did in the past. So let's just look a little bit more at these black swans and fat tails because a lot of systems really depend on them. For example, trend following systems depend greatly on these fat tails, these unusual trends. Volatility breakout systems depend on having these outliers or fat tails. But there's also very unpredictable events. It could be an earthquake or a tsunami or a natural driven event. It could be a regime change. It could be wars. It can be all kinds of unusual things that our models don't predict. So they're small frequency of occurrence, but they can cause major disruptions and have significant impacts on the markets. Who could have foreseen COVID happening and having the impact on the markets that it did? And then following that, who could have seen the world increasing the global monetary base by over 25%, which drove huge asset inflation, and it's still underway today, this global liquidity flood, okay? So recognizing these outlier events and having our risk management in place, and then resilience, because stuff happens all the time. I have losses all the time, and it's going to be your ability to pick yourself up by the bootstraps one more time and get back in the game, making sure that you have capital preservation so you can still play the game. And a parting slide before we start analyzing some charts where the best lessons of all come in. The black swan. Now, they always say that black swans didn't exist, right? I had heard that until I went to Tasmania, just south of Australia, and I saw whole lakes of black swans. And here I thought they were a rarity but there were seas. I actually took this picture of one of them and blew it up, but there were whole flocks of these black swans swimming around. Nobody tells us these things, right? But they exist in greater frequency than we can imagine. Now, for fun, let's get back to some basics of technical analysis. I am a purist. I am a pure market technician. I try to ignore the fundamentals because if I put too much emphasis on the fundamentals, I will get them wrong. That's why I call them funny mentals in English. And I figure that the large institutions have privy to better data than I do and are quicker to process these things. So, what I really want to do is follow in their footsteps and be able to eat the breadcrumbs along the way. So, there's three basic things that we need to know in technical analysis and our charting and our trading. And none of them have anything to do with indicators. You can see the charts that we're going to look at. I don't even have moving averages on them. And we're just going to look at three basic rule sets. The first is, how do we define a trend? Most people would say, looking at a moving average, the slope of a moving average, MACDs, and so forth. But in classic technical analysis, as put forth 100 years ago, a trend was defined as a higher high and a higher low, and then take that out from there. So you can see here on the charts, we have one high, one low, a higher high, a higher low, but we still need to see that taken out because otherwise it could be a simple ABC and a downtrend. So this pattern of higher highs and higher lows persists for much longer than we think. In other words, trends have greater odds of continuation than reversal. And how many times have we found ourselves looking for tops or looking for bottoms or trying to pick when that trend is going to end? I will show you how we know, and it's not any means of our own forecasting, okay? I don't think anybody thought these markets would continue on as high for as long as they have these past few years. But you can see this is Wisdom Tree Quality Dividend Growth ETF. So it's some US stocks, and it's just a steady pattern. No indication of distribution, no indication of resistance yet, just a steady uptrend. Now let's look at the next chart. And now we're going to start to put in some horizontal lines. I do a lot of work with very simple horizontal lines. Now, why do I like those? First of all, I'm using them for swing highs and swing lows that everybody sees. These are the most visible chart points out there, these swing highs and swing lows. So I always find it, by the way, this says upper. I'll have to correct that there. Just pretend that S did not exist, okay? It's upper and resistance. Okay, so the upper resistance, yes, okay. Upper resistance, 2 data points. That's all you need to remember. And support, 2 data points. That's all you need to remember. You cannot say there is resistance like here on the left where we just have one line, 1 data point only. It really takes a test of that before we can say that there is resistance. Now, I did one other trick. How many of you have heard of market profile? It's another way of displaying data, just like point and figure charting is a way of displaying data. Only I don't use the market profile charts, but instead, if we see where we can draw a horizontal line that goes through numerous bars. That's where the most trading took place. Think of it as home, sweet home for the price to revert back to. It's also how we form equilibrium points, where all the buyers and the sellers come into agreement or to balance. So then when a market pulls out of these equilibrium points, as it did right down here and right up here, one side is caught off balance. Everybody wants to chase and be a buyer or vice versa. So that's the most important thing that you need to look at with this particular chart is just how we can watch if the price tests and forms support or tests and forms resistance. And then we'll see if we take out a support or resistance area, we don't want to see it come back into that range within the next 2 bars, just as a good rule of thumb. We really want to see it keep going at that point. And here you could see it kept going and then it started to rotate again. We had the loss of range, which is another way of saying a loss of momentum. Let's look at crude oil and add a few more twists to this. So this is a recent chart of crude oil, fairly up to date. And you can see again the defined support and resistance. Now, sometimes it's not a perfect test, okay, but these are definitely 2 levels. It can be a little bit above or a little bit below, but once it moves in the other direction, you have resistance defined, and then we have support defined. Same thing here. And you can see that when we broke this, we did come back up, but then when we decisively broke it this second time, we continued on down for a while until, this is an important concept, this 3-bar balance is what often halts a trend. So you can see the 3 small bars of price overlap that happen so often before the swing reverses. Now, when this swing reversed, where did it find resistance? Right up at that high volume node, right up at that home sweet home. So we'll see this very often. Now, let's look at the chart that everybody likes to look at, gold, or as we can call it, the shiny cube, as Warren Buffett once dubbed it. So, starting at the left side of the chart, we see the steady pattern of higher highs and higher lows. Okay, this little red circles, I'll discuss those at the end, but those are areas where the market came into short-term balance. So just because you have those 3 bars does not mean that it's going to reverse. It usually means that you'll have a range expansion bar. And in this case, most of these range expansion bars were to the upside until we just had this last range expansion bar to the downside. Now, I want you to notice how long this market consolidated here before it started a new swing. This area was 5 months of duration. And what happens is that we so love playing the game when we're winning and to the upside that very often when the party comes to a stop, we want to keep on buying dips, and not recognizing quite that it's a little bit due for a bigger reaction and ignoring the signs such as this range expansion up at the top here that was getting a bit too parabolic and a bit too much of a climax bar. So very often after we have these big swings, not always, of course, but very often what happens is, how many of you are familiar with the great technician Gann, William Gann, his saying of price equals time? And he used to draw 180-degree trend lines and say, okay, the price can consolidate until we reach that trend line. So what we have here and what might happen, it's a probable function. It doesn't mean it's guaranteed, but it's very probable that gold can consolidate in a sort of triangular pattern until it winds back down to this equilibrium point again. Now, it didn't do that so perfectly after that first upswing that we saw. Instead, what we had was this ABC reaction. Now, do you remember when we looked at trends, we said to reverse that trend, it would need to be an ABC and then take out that low, okay? Because this is just an ABC correction. And overall, we still continue to make these higher lows. So just for fun, I circled a few more little 3 bars, and you can see that most of the time after these 3 bars here, we had a range expansion bar. Most of them to the upside until this last one to the downside. And now we'll see if this last flush area down, there were a few more bars in here before we reverted back up, is going to start to form a move towards the upper end. We probably have trapped people right up here, so it's probably unlikely to make a full retest up the first time it travels up. But that's the great thing about markets, is it's so important for us to take this one day at a time, one bar at a time. And each day the market gives us more information. The price and the charts give us more information. So PKO is the largest bank in Poland, and it's traded on the Warsaw Exchange. I thought it was sort of interesting that it's 30% government owned. I believe the Treasury owns a portion of it, but yet it's still a chart. It still has supply, demand driving the price. So one thing I wanted to point out was when we have these false breakouts, so you can see we had the 2 data points right here where I've got this horizontal line, and we had a big up bar, but we fell right back into that range within 1 to 2 bars. That is the best sign of a trap, in this case, a bull trap. Now, if some of you are familiar with Charles Wyckoff, who is my hero, who wrote a lot about technical analysis and structure, he called these traps springs and upthrusts. Okay, so this was an upthrust. It poked up and it fell right back down. And conversely, at the bottom here, you can see we had our horizontal line drawn with these 2 data points. We flushed below, closed below, and we only closed below one day, and then we popped right back up again until we rallied to what might be an obvious data point, the start of a gap area. Now, here's another excellent rule for you with gaps, and it'll work a great majority of the time. And you know that nothing works 100%, but here's a good gap rule. If you see a stock gap and fail to trade into that gap area over the next 4 trading days, the odds are that it will continue in the direction of that gap for the next 2 weeks. So here was an interesting example where we gapped down and then we continued to fill in that gap. Okay, so you don't want to fight it when it does that. But on the opposite side of the case, we gapped down. It failed to look into that gap over the next 3 to 4 days, and we continued on lower for at least 2 weeks. One of the reasons I know that happens in the United States is because institutions, mutual funds, pension funds very often have sizable positions on, and if they want to reduce their leverage or get smaller, they don't have the luxury that you and I have, where we can just get out in one day. It might take them 2 weeks of slowly reducing their size in a position without making a market impact, meaning driving the price down too far to get out too soon. So you have a great luxury as a discretionary trader, a retail trader, even a systematic trader, if you're not doing such extreme size. And that is that we can get in and out very quickly, much quicker than the institutions. Oh, Bitcoin, boy. Bitcoin reminds me of that GameStop stock sometimes. When it's going up, everybody's pulling out their wildest forecasts, 100,000, and then of course it really goes nowhere fast. So this has essentially been in a trading range for the last 5 months, and we have seen periods in the past where it consolidated sideways for 16 months. Now let's look at one of the characteristics of a trading range because it has much different characteristics than a trending market. And that is it tends to have a lot of false breakouts, little whipsaws. In fact, lots of whipsaws sometimes. All right. And so you can see that Bitcoin's no different. Lots of spikes, tests, rejects. Here we had our blue line, which is our equilibrium point. It started down, and all we really did was fill in this whole markup period here, almost to the tick. So you can see how perfect that was, filling in that markup period. Whereas this upside breakout from this sideways line led to a more pronounced upswing. All right. And here, once again, that test reject, as it's called, test that data point and reject that data point, very often can lead to dramatic moves in the opposite direction. Interestingly, remember how I said the narrow 3 bars can often denote the bottom of a swing or the top of a swing. In fact, volatility extremes characterize the tops and bottoms of trends, okay, especially in the stock market. Here you see this V pattern at the top of Bitcoin. But very often in stock market bottoms, we see a V bottom. And here we had another little sideways line, which led to a good push down. And the false breakout, once again, we only closed above that previous high by 1 bar before falling back in. And I am certain a lot of people were looking for this to continue on up because it felt so good if you were long during this period. And of course, it didn't. So if you're putting your stops, you do not want to see this come back down to the low of that big bar there. That's just sort of a golden rule. And of course, you can see the little traps at the bottom. Now, I remember when we fell through here, all of a sudden you had Head and Shoulders tops projections. We have to go back down to the 80,000 level. Just remember, nobody knows. Nobody knows for sure, and nobody knows any better than you or I. It's just best guesses and making projections off of perhaps the width of this range projected to the downside. But it doesn't mean there's a high probability outcome of that either. Okay, BTU has been one of my favorite stocks to watch, and especially BE, Bloom Energy, super powerful stock that helps drive data centers here in the US, the energy needs. So let's just take a look, and I'm going to ask you a trick question here. Ignore this line that's going across the chart here because your gracious hosts at your firm sent me these charts when I asked for some on the platform that you guys look at, okay? And it just happened to have a horizontal line at the last closing price. So that's the only significant of this long gray line across the charts. But before that, we can see the steady pattern of uptrends, before we went quite parabolic to the upside, formed some consolidation before we had the trap, the look up and back down that occurred over just 1 to 2 days. And now we've fallen back down. And here we are. We're missing a few days' data. So I told you it was a trick question. But what would be the logical place, just looking at this, where you would imagine support to come in on the corrective swing down? Keep your answers to yourself, and we're going to go on and look at the next slide, and it will add a different perspective and a different context. Now we have included a lot more data. Too often we make analysis on too little data or draw our conclusions from the charts on not enough data. It is important if you are trading on a 5-minute chart to also look at hourly data. It's important if you're looking at daily data to also look at weekly charts. And now that chart makes a whole lot of sense. We looked above this previous high. Remember, these swing highs and lows are the most visible chart points. Everybody sees these, assuming that they're looking at enough data, okay? And so with that said, I just want to see where this pulled back down almost right to the middle of this range here. So pretty cool. It all makes sense in hindsight, right? But make sure you're never just looking at 4-inch squares, that you put it in a proper context. Very important. Okay. Last but not least, NVIDIA, the market that has the largest capitalization of all exchanges. I drew over here on the left side of this screen a little triangle with orange lines, because a lot of people like to draw these sloping trend lines. For myself, I've found that if I draw sloping trend lines, very often I'll end up having to redraw them and redraw them. So be careful about that. I like seeing the swing highs taken out. So if I'm doing a trend following system or using that in my approach, I like to see the horizontal levels or channels taken out, so that I don't end up having to redraw sloping trend lines several times. So that's my personal preference. If you find something that works for you, by all means, that's what's most important. And you can see here as well the blue line showing how often we rotated around this price before we actually started this big uptrend. It reached that equilibrium point, or that high volume node. There was a little brief consolidation here on NVIDIA, okay, reached an equilibrium point without giving up any data. And so then we started the next leg up. And now it's gone through a much broader range, all right? We've got a broad trading range. And this is going to be a very interesting data point going forwards, because we poked out the upside of this range. All right. Technically, it has done enough work or consolidation to support a whole new swing up. And in fact, we pulled back down. This was different from our test reject. This was, we stayed outside of that area for a number of days before then forming this consolidation at a higher level. So what we've done is consolidate, 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 all at higher levels. And just the last few days, you know that this poked up above. Where did we get up to? Let me just see where we got up to just recently. We poked above 210, and then we closed at 202 on the close of the Friday that I am giving this presentation to you, okay? So now it's done a little bit of a V top up there, and so we'll have to see if it's going to hold or fold, as they say. One thing I wanted to show you with this chart, though, is at the bottom, we have volume, okay? Now, I've never used volume on my charts for the primary reason that when I was first starting to trade futures, volume was not transmitted on a timely basis. Okay, there was a delay. Now we're all blessed in the last few decades to have very expedient data right to the second here, including the volume, even the millisecond, we can see the volume, but it didn't used to be that way. And so I learned that volume is highly correlated with the range of a bar. So if you look at this chart, and I should have drawn some arrows here, you can see every place where there's a big volume bar, there is also a corresponding range expansion bar. The range expansion to the downside had this little higher volume. Here, when we broke down right here, higher volume, and so forth and so forth. It's not perfect, but my point being, don't fall into the trap of thinking that the volume's light in here, you see where we were going up and making this slow, steady uptrend, because very often in the strongest trends, you don't have surges of volume until you get closer to the top or a buying climax. And then it very often is a dog pile in or out. So personally, I think there's a lot of merit to studying volume. I don't use it though, just because it's one more thing for me to look at. And another thing to be careful of is volume intraday, because it's very distinct time of day functions where the volume is greater and it's lighter at lunchtime. It's always going to be the heaviest at the opening of the US session, at the opening of the Asia session, and the opening of Europe session. Okay? Now, just to sum up, what is going to help us the most on this journey, besides experience and studying charts and studying more charts? Having consistency, and that's going to come from looking at your process. That's how do we do our homework? How do we do our analysis, our preparation, our execution, our trade management, our research, and most of all, our mental state? Okay. Our goal is going to be to approach the market the same way every day with the same process or structural framework. We don't want to be switching tools, going from Elliott wave analysis to Fibonacci to point and figure charts to momentum indicators. Just pick one style and stick with it. And that way you'll learn the nuances. We also want to update our analysis each day. So each day brings us new information. So be careful about projecting too far out at a time. Strive to be systematic and methodical as much as possible. We've seen some ways just through those charts that we scrolled through where we can eliminate cognitive biases just by looking at the patterns with the swing highs and swing lows. Have we formed resistance or support? Are we forming a chart formation with a sideways line where a lot of data, a lot of trading takes place? So all of these things are black and white functions where we don't fall into that trap of seeing what we want to see. A true trader, you've got to learn to rely on your own homework in the long run. Now, it's okay in the learning process for a couple years if we see what other people are doing. Perhaps you're in a trading room and perhaps you're following somebody and seeing their process. You want to take the things that make the most sense to you and make them your own. Do your own study, your own analysis, perhaps print out charts and circle certain things. Okay, so you have to learn to take a style and make it your own. because you don't know if that other person has had a bad day or a fight with their spouse and they just woke up on the bed on the wrong side. So be careful about blindly following somebody else's lead. Also, the routines and rituals can help keep us in the moment, okay? The routines and rituals are our friends. There's so much to learn from the field of sports psychology. For example, how many of you have watched the tennis player bounce the ball, pick the strings on his racket, go through a little routine before he's ready to serve? It's that way with numerous sports, having these little routines and rituals. So if we forget our routine, it's just going to allow for sloppiness. Create the environment around you. That's one thing that we can control. Are your children coming in and bothering you? Do you have the TV on in the background? Is there a dog, that's coming and bugging you? My dogs like to come into my office and say, "Hey, mom, it's time to feed me," So just be aware of all these distractions and you can control your environment. So process is a substitute for us for a mechanical system. All right, you better love the game because it's a lifestyle. Last but not least, again from sports, process goals versus outcome goals. Outcome goals are the dollar amount, and that tends to trip traders up, these outcome goals. Don't think about the dollars. If you have a solid process, it will take care of itself in part when the right environment comes along. So focus going through this consistent sequence to execute and manage a trade. And instead of keeping track of the dollars, keep a record of your unforced errors and the number of times the correct process was followed, okay? That's far more important as to whether dollar amounts were met. Monitoring your performance in this way will improve upon your whole process as opposed to setting specific outcome goals like I'll quit after making X amount of dollars. Well, that's a dumb thing to say because it might be a superior trend and you might have caught a winner and let that winner ride. Don't quit while you're ahead. Perhaps that market environment is favoring your game, okay? Even if you're not a trader and you're just an analyst, the best analysts I know still follow a consistent style, a consistent methodology that they've made their own, and they don't worry about whether their last call was right or wrong. We can't look back in the past with markets and undo a trade or undo a market call. We can only look forward, okay? And it takes much longer than any of us realize. Most people take a minimum of 3 years and sometimes up to 10 years before we find what truly fits our style and feels good to us. Because we have to explore different styles, okay? So give yourself lots of time. Start with always the lowest leverage that you can so you don't make mistakes on big size. And remember that along your learning journey, whether you've been trading 10 years, 20 years, or 1 year, it's still the greatest hobby in the world. I learn new things every week, even after 45 years. Enjoy the process. Don't focus on the money. Keep an open mind. And remember, nobody knows how the market will behave the next day, let alone the next year. So risk control is 95% of the game. And with that said, I want to give a big thank you for having me on as a speaker. I was very blessed to visit Poland this summer with my mom. My daughter's husband is from Poland, and his family has a house over there as well as a condo in downtown Krakow. So I spent a lot of time in Krakow, and then I went on to Warsaw, where I met some lovely friends. So thank you again, and I hope to see your beautiful country again soon. Best wishes to all of you. Stay healthy, stay happy, and stay engaged in the greatest hobby in the world. Thank you. Oh, one last slide. My shameless self promotion, my book that I wrote on how all these bad things happened to me in the markets, all the mistakes that I made, all the wrong side of big outlier events and black swans that I was caught on the wrong side of. And as I understand, this book is in the process of being translated into Polish and might already be ready for you. So I hope you enjoy the copy. It's written with a lot of humor because we have to have a good sense of humor in this business. Thank you again, and I'll look forward to seeing you in the future.